Hi, Brian. Absolutely. I mean, the Dow actually made a high last year tomorrow, right? That was on October 3rd, 2018. It was at 26,900. Yesterday, we hit about 26,500. The S&P made an all-time high last September, the 21st of 2941, and now we're just below that again. So the major indexes actually haven't gone anywhere. And of course, when you look at it in terms of year-to-date performance, yeah, it's great. But obviously, we dropped 20% in the final quarter of last year, so we basically just regained. That is on the top indexes. But if you look at the underneath picture, the Russell, the banking sector, and the transports, they're all down about 10, 11, 12% from those highs last year. So there's a very much a divergent market going on under the surface.
You know, listen, I feel like I've been doing this 20 years, so I've come in, I can editorialize just a bit. I don't remember the manufacturing number moving the market. We had a 400-plus point swing when the manufacturing data came out, Sven. I can't remember, I'm sure there were times, but I can't remember any time when that piece of data, which is not ignored, but it's not the most important thing in the world, moved the markets that much. It told me that the market seemed to be fragile underneath, that the market, I don't want to say wanted to fall, but certainly was weak enough that that data triggered it.
Well, it's interesting. I mean, this entire year, and I got to keep emphasizing this point, we've not rallied on earnings growth or economic growth. We've rallied on multiple expansion driven by the central bank put of the Fed cutting and easing, and obviously on trade optimism. And I said in the spring, and I'll say it again now, the longer this trade war drags on, the worse the drag or impact will be on the macroeconomic data. And we see that globally. We see that basically there's a global manufacturing recession building. And I think the market is going to be running out of patience here very shortly. And yesterday's reaction to this ISM print, as you noted, is very telling, because this is really the first time the market has markedly reacted to negative economic data. It's ignored it all year, running on multiple expansion. So this trade meeting next week on the 10th of October, I think, is really critical, because markets want to see actual measurable progress. We can't keep running on trade optimism headlines alone.
Yeah, but I'm not knocking all the hardworking manufacturing people out there in the United States and where you are in the UK and around the world. But manufacturing here in the States anyway, Sven, as you know, is a relatively small part of our economy. How important is that services number tomorrow going to? Suddenly now all eyes at 10 a.m. are going to be on that services number, I would imagine.
Yeah, look, the consumer keeps holding up the U.S. economy. I think the question is, will we see a spillage into the services sector in terms of consumer confidence? Consumer confidence actually has slowed down a little bit in recent weeks. And also the labor market has slowed down. And of course, we have this continued trade uncertainty. If we get something substantive out of this meeting, I think then obviously we have a lot of potential to move higher. To the extent that we don't, and we get maybe some sort of interim deal or nothing substantive that keeps the uncertainty going, I think rallies continue to be a sell. And from my perspective, this going into fourth quarter, consumer confidence is incredibly important to watch, and we'll see this now coming with earnings in here in October, because earnings growth is actually negative, and there's margin compressions on the side of companies, and we have to see how they react in terms of their labor hiring plans going into the fourth quarter.
All right, I like the bottom line. If we do rally for some reason, you want to sell those rallies. There's your bottom line for the NorthmanTrader, Sven Henrich. Sven, always a pleasure. Have a great day. Talk to you soon.